Buying your first home is a major milestone, but as you settle into that space, it is natural to start looking at the property as a foundation for long-term financial stability and generational wealth. Many online guides portray real estate as a machine for guaranteed passive income. The reality is often defined by operational stress, legal liability, and the constant friction of managing a physical asset. Selecting the wrong investment path can result in a high-stress second job that you never intended to take on. You risk your capital and your time if the strategy doesn't align with your daily capacity. To avoid that trap, we need to evaluate 4 distinct real estate paths to determine exactly which one fits your specific resources. We'll evaluate long-term rentals, fix and flips, short-term rentals, and commercial real estate. They sit on distinct axes of time, capital, risk, and yield. We'll use Massachusetts tax codes and regulations as a reality check to see what these strategies actually require. Success depends on choosing the specific path that matches the time, capital, and risk tolerance you have available right now. Residential long-term rentals are the traditional starting point for investors focused on building steady, dependable equity over several decades. The primary outcome is a consistent revenue stream that pays down a mortgage while the property itself appreciates in value. This stability requires locking up significant capital while navigating a dense environment of local tenant protection laws. Under Massachusetts law, you are strictly limited in what you can collect from a tenant up front. You can only ask for the first month's rent, the last month's rent, a security deposit capped at 1 month, and the cost of a new lock and key. You are also responsible for maintaining strict habitability standards and must provide 24-hour notice before entering a unit, regardless of who owns the deed. This is a low-velocity wealth accumulation game. It is for those who value long-term security over immediate liquidity or operational flexibility. Fix and flips offer a different timeline, focusing on rapid, lump-sum capital injections rather than monthly rent checks. This path requires high sweat equity and immediate access to a reliable network of local contractors. You are essentially trading labor and project management skills for profit. Success hinges on the accuracy of your renovation budget and neighborhood comps. Even a small miscalculation in material costs or resale value can eliminate your entire profit margin. As the scorecard shows, these projects are highly volatile. They are vulnerable to unforeseen repairs, timeline slips, and fluctuating interest rates. Because you sell the asset to realize the gain, you retain no long-term passive cash flow and no future equity in the property. Flipping is an active, high-risk job. It is suited only for those who can directly control renovation costs and understand the nuances of local resale trends. Short-term rentals, or STRs, are designed to capture the highest possible nightly rates and maximize the yield from a single property. This is a hospitality-intensive management role. You are responsible for daily guest communications, cleaning schedules, and constant property maintenance to ensure high ratings. The regulatory requirements are just as demanding. In Massachusetts, every STR operator must formally register with the Department of Revenue before listing a property. The scorecard reveals significant financial friction. You must collect a 5.7% state excise tax, and many towns add local taxes that push the total tax burden above 11%. Cities like Boston and Cambridge have restricted short-term rentals to owner-occupied units, effectively banning absentee investors in those markets. An STR is a demanding hospitality business. It requires daily attention and remains vulnerable to sudden changes in local law, making the income far from passive. Commercial real estate is often the next step for experienced investors seeking scaled diversification beyond the residential market. Valuations here are driven by math, not emotion. Property value is tied directly to income generation, operating costs, and the strength of the existing leases. The primary benefit shown on the scorecard is predictable cash flow. Multi-year leases with business tenants provide a level of stability that residential rentals rarely match. However, the entry requirements are high. You need significantly more upfront capital and a deeper understanding of commercial contracts and zoning. You must also account for vacancy risk. While residential units often fill in weeks, a commercial space can sit empty for many months, requiring deep cash reserves to cover the mortgage during the gap. Commercial investing requires making decisions based on financial metrics alone and having the capital to survive long-term market cycles. Your financial goals should not be the only factor in your decision. The strategy you choose must align with your current lifestyle, your technical skills, and your actual tolerance for risk. This quadrant chart weighs management effort against potential yield, helping identify where your resources are best spent. For a stable 20-year game with limited daily time, residential rentals are your match. With trade skills and a need for immediate capital, look at fix and flips. To maximize monthly cash flow through hospitality, choose short-term rentals. And with large capital reserves, trade tenant management for math-driven commercial real estate. Generational wealth begins with one highly calibrated decision. Assess your resources objectively, learn the local laws, and intentionally choose the type of operational friction you are most equipped to handle.